How we doing? Today is Tuesday, the 6th of August, 2024. Uh, just doing our weekly Zoom here in regards to seller financing and real estate notes. What we've been doing is breaking down seller financing, and eventually we will get to real estate note investing and real estate notes. But because they go hand in hand. When you create seller financing, you're essentially creating a real estate note. And so what we're doing here is just continuing our series. This is session number 5 on seller financing, and we're going to discuss the 10 steps to successful seller financing. We're going to quickly go through what the 10 are, and then we'll kind of break each one down a little bit further in depth. We won't get through all 10 this time. I'm gonna try to get through at least about 3 to 5, and then again on Thursday, we'll continue this and try to get through all 10. With that being said, let me get my information here. So the 10 steps to successful seller financing. The first thing you have to do is identify your team members and get them involved. The second thing is to determine sales price and what your terms are going to be. You want to market your property with owner financing. You want to pre-qualify the buyer for the particular property. You want to negotiate the terms with that particular person. So you may come into this wanting certain terms, but after speaking to the buyer, a lot of times you may be able to change those terms in your favor. Sometimes you may have to do some things to put it in the buyer's favor. You're going to put offer and acceptance in writing, get earnest money deposit from your particular buyer once you have everything in writing. We're going to underwrite and do like a credit quality, make sure that this person is qualified, make sure that they can afford this particular home. And you're not going to specifically be doing this, but this is one of the steps to successful seller financing. You're going to request title and complete contingencies. You're going to set up a closing, obtain the settlement statement, and review docs. And then you're going to close and then record the documents accordingly. Again, these are all things that you individually may not do, but we want to make sure that all of these, are done. So we're going to start with building the team. So if you're someone that is looking to sell a property and use seller financing, or if you're someone that wants to buy with seller financing, or if you're an investor or whoever, if you're just going to be dealing with seller financing in general, you want to make sure that you have proper people on your team. And this could, not every team member is going to go for every situation, but pretty much all of these, that you're going to want to have on your team. The first is a real estate agent, especially if you're a seller. You want to have a real estate agent that can put your property out there and let them know that you are potentially offering seller financing. This way, you can have someone assist you with the procedure of selling a property, make sure that all of the I's are dotted and T's are crossed, so to speak. And, so you want to have an agent on your team. Real estate attorney or an escrow closing agent, person that's actually going to close the transaction, and the attorney, you want to have someone that is familiar with selling with seller financing and dealing with seller financing on a particular piece of property. The title company, you want to know who the title company that maybe your attorney is using, or the closing agent. Make sure that they are, a company that knows about seller financing, understands the ins and outs, the legalities, the paperwork, the documents that go along with this particular transaction. A lot of title companies may not do seller financing, or depending on the situation, if there's an underlying lien and things of that nature, there's some title companies that won't want to work on getting that transaction closed. So you want to make sure that, you have someone that is knowledgeable in that particular area. An accountant or CPA. Again, you want this because you want to explain to them, what you're trying to accomplish in this particular transaction, and have them guide you on the best way forward to accomplish all of your accounting and the tax goals and things of that nature. So we want to make sure that you have them on your team, and they're made aware of this particular situation. A self-directed retirement plan. So a lot of people have a regular IRA or some type of company-sponsored IRA account. But when you are going to do seller financing, and a lot of times this is people's wealth that has been built up in their particular house. You've lived there for a certain amount of years. The house is worth hopefully considerably more than what you paid for it, and it makes up a big bulk of most people's wealth. And then what you may, what we suggest is that, from these proceeds that you're going to get from selling this property, you want to look into a self-directed retirement plan, because you have more control over this particular retirement plan. And so the money from the sale of the property can go into this particular account, and then you can then make other investments for the future. If that is, what you're looking at, if that is your main concern, with selling this piece of property, is to make sure that, my retirement is secure, you can put it in this type of account, and then you can use this account, use those funds that are in that account to make that account grow. And then also the payments that you structure to receive on a monthly basis, maybe you want that to kind of go into your retirement plan as opposed to coming to you directly. It could go straight into your retirement plan for when you retire. So having a self-directed IRA person is what we recommend as well. You want to make sure that you have a mortgage loan officer, sometimes referred to as a RMLO, which is a registered mortgage loan officer. That is the person that's going to help you with qualifying your particular buyer, making sure that this particular person can afford the house. And then it actually takes the responsibility off of you having to know all the rules and regulations and things of that nature when it comes to having a buyer qualify for a property. You can give it off to a third party. They can make sure that this particular person, can afford this property. And then you can always go back, if somebody tries to say, well, they sold me a property that they knew I couldn't afford, you can go back and say, look, here's the evidence. This person went and saw a mortgage loan officer, and at the time, they agreed that they were, that they could afford this particular property at the time. So it really takes a lot away from you. A servicing agent, and that is a servicer, meaning that as these payments come in on a monthly basis from this seller financing, you're going to want a servicer to handle those particular payments, make sure that they're dispersed properly, if they are going to go to your IRA or if they're going to come to you directly. You want to make sure that third party is handling that and making sure that you're getting you're getting that stuff. There are things that you do not want to provide: legal advice, financial advice, investment advice, loan origination services, be a real estate broker, or securities for the sale. These are things that you want to stay away from, and this is why we can outsource a lot of this stuff, so we're not responsible for it. It's people who have licenses, who have the necessary knowledge and information in your particular state to make sure that this transaction goes through smoothly. And there's, things like the Dodd-Frank Act, CFPB, the Consumer Financial Protection Bureau, the SAFE Act, TILA, which is the Truth in Lending Act, and RESPA, the Real Estate Settlement Procedures Act. So we want to make sure that when we do this transaction, that we have the professionals in place that can make sure that we're doing this properly. Those are just a few things that we want to have in place when we talk about building our team. That's step one of this. We want to make sure that these people, that we have these things in order, as we go through this particular process to sell this particular property with seller financing, or if we want to buy this particular property with seller financing, to make sure that, it goes through properly. So the next one is determining sales price. And, obviously this is really important because you can sell your property for the most amount of money when you do have seller financing. So, because you are selling it with seller financing, it increases the value and profit that you earn from interest income. So, understanding what properties in your area are worth. And there's a few different ways that you can do that. You can do that through a BPO, which is a broker's price opinion, which is prepared by a real estate agent um, or a broker. They will look at the comps in the area and tell you that your property comes in between, let's say, 100,000 and 110,000, somewhere in there. It'll give you an idea of what your house is worth. You can actually get an appraisal. If you want to spend the money to go ahead and get an appraisal, you can do that. This is probably not necessary. Getting that real estate agent that we talked about, that person on your team, they should be able to provide you some good information on what the property, is worth. We want to be able to minimize the risk when we do this. Obviously we don't want to take great risks, when doing this, and we don't want to, we want to make sure that we're not, selling this property, too far over and above what the value is, and putting a potential buyer in a bad situation. We want to preserve affordability for the buyer. Again, we want to make sure that, that this is going to be something that, they can make that payment on, because it doesn't do anything for anyone if we, set this up the wrong way and then we get the buyer in a bad situation and then they can't make the payment. It doesn't do any good for the seller. It doesn't do anything good for the buyer, and just makes a lot more work. So we want to make sure that, that we have a good sense of what's going on in the market. What can people afford in this particular area that I live in, and make these numbers work. You want to maintain liquidity. So the good thing about seller financing is that when you do seller financing, you can always sell either a portion of your note that you've taken back and you're receiving payments on, or you can sell the whole note if you need some money to do something happens in your life 2, 3, 4, 5, 6, 10 years down the line, while you have this seller financing property that you've been collecting monthly payments on, but you need maybe to cash out, so to speak, or you need a lump sum of money. You can do that when you have remaining payments still out there. You can either sell some of them, or you can sell the whole thing. And then again, by understanding the numbers, we know, what this potentially could sell for if and when we needed to take some money out of it. But again, if we don't understand what our price is, and we're pricing it, well above, then we're probably not going to get the money that we need out of it at the time that we need it, because we didn't understand, what the price or what the sales price is in that particular area. We want to maximize note resale value. So again, we talked about that, is that, if we need to, sell our note, that we get the most out of it. And so when we look at, seller financing, it is an amenity. It is like having a third bathroom, like having a finished attic, excuse me, a finished basement, an apartment over the garage. When you sell with seller financing, it's considered an amenity. So because of that, we save the buyer points and fees. We save time. We can close these transactions a lot quicker. They're easier qualifications when it comes to selling with seller financing. We don't go through all of the same things that the banks have to go through and what they're regulated to do. But that's not to say that we're just letting anybody in the property, but it is an easier process. So because of this amenity, we are able to sell, at a premium. So, going back to the example of $100,000 house, if the neighborhood is worth 100,000 and your person next door to you is selling the house for $100,000, you typically could sell your house from somewhere for about 110, to maybe $115,000 because of this amenity, because you're offering this that your neighbor is not offering. So, we have to make sure that we understand where we are, in terms of the price, but we are going to charge a premium for this because we are offering this amenity. And we want to understand what is the payment that the potential buyer can support. Um, you know, we want to look at, what the rent is probably in the area. And you want to be, obviously, usually it's going to cost you a little bit more to own than it is to rent. But let's just take examples now. Rents in a lot of areas are up. They've been going up for a while. Um, and if you understand what the rental value is, if you can make this house the same price as the rental value in your area, or, within a reasonable, maybe $300, maybe a maximum about $500, somebody most likely is going to want to purchase from you as opposed to rent, because they know that at least they can build up equity over time for, just about the same payment. So if you can definitely keep this payment at what the rental value is, you have a really great chance of, selling your house with the seller financing and getting more people to want to buy this particular house, because they know that, hey, if I'm going to pay, $2,000 to go rent somewhere, I might as well buy this property and make this particular payment. So that amenity is a great thing on this. You want to maintain, best practices. You have to understand the seller financing disclosures, consider state laws and advertising with Fair Housing Act. And this is why we have the team. Again, this is why you have a real estate agent or some type of broker that you can go to and make sure that you are within, all regulations of that particular state. Again, this is why you have the attorney. You have the the residential mortgage loan officer. So we make sure that we're doing things above board, making sure that we have a clean transaction here and we're not making any mistakes. So we want to maintain, those best practices. So, when we do write these things, writing them correctly is a big part of this. And kind of like I guess, best practice, you would say. I'm going to go over what the best practices are when it comes to, creating the seller financing. We try to take at least, 20% down, 10% at the minimum. Again, this, by taking this amount down for down payment, this allows the default level to go down quite considerably. Now, it doesn't say that, people can't default, because life happens to everybody. But if you know that you put $20,000 down on $100,000 property, if something does happen in your life, a lot of times you're going to try and, give this person a call and work something out with them, the person that holds the note and created the note, and say, is there something that we can do? Can we do a modification? Can we do something like that? Because they have a significant amount invested. Right now, some of the highest delinquencies right now are in FHA mortgages. It's over 10%. It's getting close to 15%. A lot of times people look, only put 3% down. I'm in this $300,000 house and I only came out of pocket, what, $9,000? It may be simple to walk away, as opposed if they had put down 35, 40, $50,000, they're probably going to make a different decision if they do run into trouble. So we want to try and get at least 10% down, somewhere around 20. The national average, if you take all the properties that were seller financed back in 2023, it was over 20%. It was about 24%. So you can get, significant down, on these particular properties. The credit rating, I mean, we'd like to see at least a 680 credit score. We want to write these at 9 or 10% for 20 to 30 years. So that's 240 months up to 360 months. We want to try and make sure that their debt to income ratio is around 45%. if we can make that lower, that's great. That's kind of like the maximum at about 45%, because that's a big portion of someone's income going just to their living. If you can be somewhere between 35, 40%, I think that's a really good sweet spot to be in. You want to make sure that you are taking out the reserves for taxes and insurance, meaning that they are escrowed. So we want to make sure that that's going again to your servicing company. They're making sure, one of those team members that we talked about, we're making sure that that part of it, of the payment, is going over into the reserves to make sure, if taxes adjust or something adjusts from year to year, we have that money going there to take care of that. So, you may say, if somebody's got 20% down, 680 credit score, and you can afford about, 45% on their debt to income ratio, how come they're not getting qualified? That's a good question. But it happens every single day. It happens every single day. Not saying that everybody's going to be, above a 680 credit score, and give you, 20 or more percent down. But there are a lot of people out there that have, decent credit scores, and some of them, have some more issues with their credit. But if you can find these people, and because of how they make money, a lot of times is the reason why they get declined from a traditional bank. So we're living in an economy now that the way people make money has changed. And sometimes you get people, obviously, that are self-employed. Maybe they only work a certain amount of months during the year. They make all their money within a 6 to 9 month time frame. And banks look at that as a little bit more risky. And just plus the times that we're in right now is that banks are, kind of pulling back on their lending because of, just the times that we're in right now. There's a lot of stress in commercial real estate and things like that. So you'll be surprised what type of buyers come to you with what type of, down payments, what their credit scores are, and what they can afford to pay. So if we can get it in with these particular terms, if we needed to, sell this note or do something with this note at a different time, we would get maximum dollar amount, for this particular note that we're trying to sell. So let's go to the next one. So, we're just at about 30 minutes, so we're gonna stop there for today. Because like I said, I don't like for these to go over, 30 minutes. So we're just gonna continue to break this down piece by piece. The next part that we'll get into is marketing for owner financing, if you're gonna, how you want to market this particular property. But I think we got a good foundation on, what we need to do to kind of take these steps to put ourselves in a good position to sell or finance, starting off with, creating that team, a team of people around us that we need. And then, how do we create this note in a way that's best for the buyer, best for us as the seller, or whoever the other, party is in the transaction. So we kind of, touch based on those things as well. So next week, like I said, we'll talk about marketing. I mean, not next week, but on Thursday, we'll pick up. We're talking about marketing for owner finance, and we'll just continue, our series on owner financing. If you have any questions, if you're a potential seller, if you're a potential buyer, if you're an investor that has rental properties, whether, single family or maybe multifamily, and you have any questions about potentially doing seller financing, please reach out to me. My telephone number is 973-475-8488, or you can shoot me an email at investorgmr@yahoo.com. We can, get any questions answered, set up a time to talk if you have, further questions. So reach out to me, and, let's talk about it. But great time to think about seller financing, no matter where you are. If you're looking to get into real estate or already in real estate, or if you're a potential seller, if you're a potential buyer, you want to consider and try to, possibly look at, some of these opportunities that are out there. All right. So I'll see everybody on Thursday, 8 p.m., same time. All right. Have a good one.